Good evening. This is Doc Severson for the Theo Night Report for Thursday, March 1st. I am cutting this video about 90 minutes before the cash close today. But so far, we're seeing a big distribution day. Right now, the S&P is down about 46 handles and could go lower. Right now, we're not seeing any kind of a trend change to the upside yet, but we'll keep an eye out for that. So how do we approach a day like today? Is it a guarantee that now we're heading lower and are going to retest the lows? I don't think so. Not just yet. Let me outline how I'm going to frame this out. So first of all, if we look at the fibs from the 350-point move to the downside and then the bounce back up again, we can see that the price has exceeded and closed well above the 61.8% retracement. Now, that doesn't necessarily mean anything other than the fact that the odds have improved for a retest of the highs. And in fact, we've already seen the Nasdaq and many of the big cap tech stocks already hit or exceed the February highs. Okay, so looking at this right now, what I see, although this does have the potential to be a higher low, in which case the price coming down through here does increase the odds that the next high becomes a lower high and we roll over again. And that would be entirely consistent with the entire forecast that we expect, which is sideways and volatile market character for the next 3 to 4 months. So we've been talking about this quite a bit lately, is that we're expecting a test of the highs, we're expecting a test of the lows. Probably both of those will occur at some point here in the next 3 to 4 months. Which one will happen first? Well, last week you would have said a retest of the highs is pretty much a done deal. Not so far today, because today is all about uncertainty. Not only Powell, but also now the administration is talking about tariffs on steel and aluminum. And so that is going to start a trade war, and all of a sudden we've got uncertainty back in the market again. So more than likely, we will see tests of both the highs and the lows of the 350-point range at some point here in the next few months. So what we can do to understand how this current downtrend fits into this, let's get rid of these fibs. Let's remove these. And now what we're going to do is we're going to draw these off the bottom. We're going to draw these off the bottom, and this is pretty close to where the S&P futures also died out. So we're going to draw this from top to bottom, and we can see that right now, as of today, we have tested the 50% retracement of the move back up. So that by itself doesn't necessarily mean anything. What we're going to watch for is the 2630 level, which is the 61.8 fib. If the price closes below there, then the odds of retesting the lows or maybe even undercutting the lows have definitely increased. Now, right now, what I want to do is, if we do get close to the lows again, I want to look at that area as a place where I can sell premium again. The other thing that we have done, and I went over this in my Tuesday video, is that I've got call spreads at the top and the bottom. These are cheap call spreads that I paid somewhere between 10 to 15 cents a piece for. The upside ones are in March, the downside ones are in April. Give myself a little bit more time for the retest of the lows because tops are a process. So either of those two will pay off really, really well if one or both of those do happen in the next few weeks. So for right now, for the S&P, this price coming down here over the last 3 days is certainly scary for a lot of people that the price is retracing very quickly. Also notice, though, that the upside move has exhausted the daily fractal, and it's going to be more likely that we're going to see more of these shock reactions just to restore the price. So watch for any kind of a bounce up. If that bounce turns into a lower high, then we're very quickly going to be heading lower. So watch for that lower high setting up on the S&P. But right now, the price finding support at the 2660 with 90 minutes left to go in today's session means no panic just yet. Now, on the other hand, the Russell, let's take a look at the Russell here. The Russell is in a little bit more trouble. So again, we had the same kind of thing happening. We had the price well above and closing above the 61.8% retracement. Now the price is coming down really hard and is in some ways leading the market lower. So let's go ahead and do the same thing here. Let's go ahead and get rid of this set of fibs and draw the next ones to the upside. And you can see that once again, we've undercut the 50%. Right now on the closing level, it's just barely holding that 1500 level. So that would make sense. That's a round number support level, which is going to be widely followed. Although what I find is that the Russell is not necessarily as clean as the S&P when it comes to technically following patterns on the chart. But once again, for the Russell, we see that the 61.8 fib here is down about 1486 or so. If the price does close below there, then we're probably going to get an undercut of the former lows. Undercuts are really good because they get everybody to completely panic and capitulate, because a lot of stops are run through there and people say, oh no, it's making lower lows, and so it's time to wash out. Again, I still believe that this is just going to be a large consolidation zone, even if we are going to be heading down into a bear market. Sideways and volatile patterns here typically stay for several months before they finally start to release to the downside. If we need any further reminding, we can just go back to 2007, 2008, and we can see how torturous that high was before it finally released. Most of the selling does occur at the very bottom of the move. This is just the warning shot over the bow for anything that might come later. Let's just take it 30 days at a time. Let's not try to overthink this. Let's just frame in the price action and then respond accordingly. That's it for today's report. Thanks for listening. We'll see you tomorrow.